Hello everyone and welcome to this December 6th edition of Property Perspective. Today I have the pleasure to be with Matthieu Arseneau. Hello Matthieu.
Hi Simon.
And Stéphanie Castonguay. Hello Stéphanie.
Hello Simon. Hi Matthieu.
Our topic of the day, the famous FHSA, or if you prefer, easier to pronounce, the First Home Savings Account. So before we go into that discussion with Stéphanie, let's talk about the recent macroeconomic context influencing, as you all know, the real estate market. Matthieu, several questions for you. To start, we see signs of economic slowdown recently. What your latest developments on economic growth and on the job market in Canada?
Again, I'm not bringing good news, Simon, for the economic situation. We got the Q3 GDP numbers recently. It was an economic contraction of 1.1% for GDP annualized. That surprised the consensus of economists expecting a stagnation of the economy. So it was worse than expected. International trade was a drag on growth. There was less investment in inventories that led to this decline. So sometimes, and that's what we do, economists focus on domestic demand to see how the domestic economy cope with the current tightening in monetary policy. It was increasing close to 1.5%, as you can see on that chart, the blue bar. But you have to get the clearer picture, you have to remove the general government expenditures that drove this increase. If you exclude government intervention, in fact, you can see that private domestic demand was contracting in Q3. So yes, we have economic weakness in terms of for the Canadian economy at this point. And what we are seeing in the labor market is consistent with this weakness. We saw an increase of the unemployment rate since April, 8 ticks increase. Given the tightening and the tightness of the monetary policy at this point, clearly hiring is not following the increase in population that we are having. So newcomers have more difficulties to integrate the labor market, but it's not just newcomers. When we see there has been an increase in layoff over the past few months. In fact, as you can see on that chart, the share of unemployed that have been laid off is increasing at this point. So there's clearly these economic difficulties. We're seeing an impact on the labor market at this point.
Wow, Matthieu, things are changing rapidly. Just recently, companies were, they mentioned they were affected by the labor shortages. Can you tell us more about that? And also, what's the impact on the inflation rate?
Yeah, of course, when we look at, in fact, shortage of skilled labor, and things change really fast, and I think we cannot talk about that anymore in the current context. If we just look 18 months ago when the rate hike started in Canada, clearly, main concerns of small businesses was shortage of skilled labor, shortage of unskilled labor, shortage of input products as well. We remember that there was concerns and problem with the global supply chain during the pandemic. And insufficient domestic demand was not that much of a concern. In fact, only 23% of small businesses were saying that it was a problem. It doubled over this 18 period, and it's now in November 2023 the main concern of small businesses. So clearly, those economic difficulties, they are much more concerned about their sales than that they will not be able to hire, and that's a concern for the coming months in terms of economic growth and for the labor market. The good news is that with economic weakness come softer print in inflation. And as you can see on that chart, core inflation, the average of the two measures that is tracked by the Bank of Canada, has been continuing to decline. So it was stabilized, but there's progress over the past few months. And now we have core inflation still a little bit too high in the eyes of the central bank, but still the lowest level since 2021 at this point. So there's progress on that side. And that's a good news, because we could have economic difficulties with still high inflation, and that will be a problem for central bank. But given those developments, it opened the door for potential rate cuts in 2024.
So that's a good news, Matthieu. So really, investors can start dreaming about a rate cut in spring. And what does that mean for the housing market in 2024?
You know, Simon, that we had this scenario for a couple of months for first rate cuts in the second quarter of 2024. So no, there's no rate cuts announced by the Bank of Canada at this point. But given those developments that I presented today, we can hope for that. But now market is on our side, is sharing our view for this rate cuts coming sooner than later, as soon as Q2. And as a result of that, 5-year rates, government 5-year rate, has declined sharply because of those anticipation of potential rate cuts coming in the next few quarters. We can see that. And as a result, mortgage rates decline as well. And that's a good thing, because we are seeing some weakness in the housing market at this point after a slight rebound in home sales activity last spring. The momentum is fading clearly, as you can see the red line on that chart. Active listings is increasing, so supply on the market is increasing relatively fast at this point. So we are starting to see home price decline again, and we expect that trend to continue for a couple of months. So with affordability being such a concern in Canada, it's good news to see rate declining and home price declining. And that's maybe the good news of my interventions today. Over the next 12 months, we could see an improvement in affordability because of those developments.
Hey, thank you very much, Matthieu, to give us some hope. And with this excellent update on the economy. So let's now discuss our main topic, the first home savings account, a tool that is proving extremely popular at the moment with first-time buyers who are looking to buy their first home. Just before I begin, I just want to acknowledge our colleagues at the bank who made the bank the first financial institution in Canada to be able to offer that product to our clients since April of this year. So, Stéphanie, can you explain to us what is this famous FHSA account?
Yes, of course. FHSA. In summary, Simon, the FHSA is the registered account that allows first-time home buyers to contribute up to $8,000 per year and up to $40,000 in their lifetime, tax deductible. The investment income in the FHSA is tax-free, and the withdrawal for the purchase of a first home is non-refundable and non-taxable. Once opened, you have a maximum of 15 years to make your withdrawal for the purchase of a first home, and also the contribution room accumulate only from the account opening date. Once your account is opened, up to a maximum of $8,000 of unused FHSA contribution room can be carried forward to the following year.
Stéphanie, what conditions need to be met to open the first home savings account?
Yes, to open an FHSA, you must be a resident of Canada and be between 18 and 71 years old, and you must be a first-time home buyer. This means you must not have lived in an eligible home that you or your spouse owned at any time during the current year or the previous 4 years.
Wow. Last question for you, Stéphanie. Can you give us some advantages of opening or contributing to the FHSA before December 31st of December this year?
First, the advantage of opening your account this year is to begin to accumulate FHSA contribution room. As I said, the contribution room accumulates only from the year the account was opened. Once your account is open, up to a maximum of $8,000 of unused FHSA contribution room can be carried forward to the following year. For example, if you open your account this year but don't invest into it, next year you could contribute up to $16,000. Also, unlike RRSPs, contributions that you make to your FHSA during the first 60 days of the year are not deductible on your previous year's income tax return. So the advantage of contributing before December 31st is that you can deduct the amount of your contribution from your taxable income for the current year. And this tax savings will allow you to have more money to contribute to your FHSA next year. So the FHSA helps you accumulate your down payment faster for the purchase of your first home. If you are eligible today, I invite you to consult your financial advisor who will evaluate the best option for you.
Hey, thank you, Stéphanie, for your very clear explanations. As you can see, the first home saving account is a powerful tool to help you achieve home ownership. It allows you to save faster, more efficiently, while benefiting from tax advantages. It also lets you diversify your sources of financing for your down payment, complementing, obviously, the RRSP or TFSAs. So, thank you for being with us today, and join us again in January for our next Property Perspective. And until then, I wish you a great holiday season.